Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, January 16, 2024. Hope everybody's having a good day out there and hope you had a good holiday weekend. Markets were closed yesterday, so there was nothing for me to do or talk about. So we're going to do the weekly economic update, which we usually do on Monday. We're going to do that today. And it is like I said, hope you had a beautiful weekend. It's beautiful here today in Colorado. Finally, it's above freezing. I think we're up to 34 degrees. Spent the whole weekend below freezing, which was not very fun. So, and actually all of yesterday, I think, was below zero. So it was quite chilly. So we did some chores around the house, painted some rooms, stuff like that. So did not want to go outside. I think only the dog went out. I think maybe a few times. It was pretty chilly. So anyways, hope you're having a good day. If it is your first time watching Liberty Call, if you would do me a favor, if you could give me some thumbs up, like, share, subscribe, follows, and press the notification bell. All righty. Well, let's go ahead and get into today's numbers and see how they turned out. A lot of red. Dow Jones was down 0.62%, 231 points. Closed at 37,361. S&P 500 was down 0.4%, closed at 4764. NASDAQ down 0.19%, closed at 14,944. The VIX was up 4.3% today. It's at 1382. Canada was down 0.54. Brazil was down 1.61. And Mexico down 0.71. Over in Europe, Germany was down 0.3, UK down 0.48, France down 0.18, Netherlands down 0.12, Spain down 0.82, Italy up 0.03, so basically flat, Switzerland up 0.2, and Portugal down 1.35%. Russian exchanges were both red today. The MOEX down 0.17, the RTSI down 0.34. And the Asian markets, the Nikkei in Japan was down 0.2%, Australia down 1.09. Right now, New Zealand is down 0.13. In China, the Shanghai was up 0.27, the Shenzhen Component up 0.31, China A50 up 0.62, DJ Shanghai up 0.28, Hang Seng down 2.61%, and the Taiwan weighted down 1.14%. So for most of the global indexes, it was down. It was a down day. So who knows? Maybe coming off the holiday or not. Well, my biggest guess is probably it's what the Fed's going to do. That's basically affecting most global finances right now. Is what is the U.S. Fed going to do? Because then that affects everybody else. All righty, well, let's go ahead and jump over to the weekly update. All right, stocks pushed higher last week, led by big tech names and boosted by December inflation reports that were mixed but positive enough to shore up investor confidence in Fed rate cuts this year. All right, don't get too far ahead of yourselves, folks. It was a rocky week that ended on a high note. Stocks rallied Monday after the prior week's decline. Tech shares led, with NASDAQ posting its best day since November 14th. On Tuesday, stocks initially tumbled but recovered most of their losses late in the session. Stocks rallied on Wednesday ahead of inflation news the following two trading days. Stocks fell initially on Thursday in response to a hotter than expected inflation report reflecting investor concern about the uncertainty, timing, and extent of Fed rate cuts later this year. On Friday, the start of the earnings season brought mixed results from a handful of major banks. By close, stocks had recovered most of their losses, ending the week with solid gains. All righty. A tale of two inflation reports. The biggest economic news last week was fresh inflation data. The consumer price index rose 0.3% in December over the prior month and 3.4% compared with the prior year. The number that was higher than the 3.2% increase economists expected and a few ticks elevated from the 3.1% figure in November. Core CPI for December, which excluded volatile food and energy components, rose 3.9%, a slight decrease from November's 4% gain. And on Friday, the producer price index, which measures inflation by domestic producers, showed a 0.1% drop for December, possibly suggesting that the CPI's uptick may have been an anomaly. Well, we'll see next month. Key data coming out this week. On Tuesday, we have the Empire State Manufacturing Index. Wednesday, we have retail sales and industrial production. Thursday, we have jobless claims, housing starts, and petroleum status report. Friday, existing home sales. We got a bunch of companies reporting earnings this week. Tuesday, we have Morgan Stanley, Goldman Sachs, and Interactive Brokers. Wednesday is Charles Schwab, U.S. Bancorp, and Alcoa. Thursday is M&T Bank and Northern Trust Corporation. And Friday is Schlumberger, Travelers, and State Street Corporation. All right, so that is the weekly wrap. Was there anything else of any importance? I guess that's about it. So For those on my mailing list, you can read it in full at your leisure. All right, let's get to the market recap for today. U.S. stocks slip as Treasury yields jump after early rate cut bets cool. All righty, U.S. stocks experienced a decline as investors absorbed various earnings reports and a surge in Treasury yields following the Federal Reserve Governor Christopher Waller's remarks downplaying the urgency for rate cuts. Goldman Sachs saw a nearly 1% increase after reporting better than expected Q4 results, with strength in equity sales and trading offsetting weakness in its core investment banking unit. However, Morgan Stanley reported mixed results, missing analysts' expectations due to $535 million in charges. It's probably chargebacks. PNC Financial Services delivered positive figures, but provided a soft outlook for 2024. Waller's comments on the Fed's rate cut expectations cooled optimism for an early cut in March, leading to a sharp rise in Treasury yields. Tesla shares dropped 1.8% after CEO Elon Musk expressed discomfort with growing the company's AI and robotics leadership without achieving at least 25% voting control, doubling his current 13% stake. Spirit Airlines plummeted over 52% following a federal judge's decision to block JetBlue Airways' acquisition, citing antitrust concerns and potential harm to consumer airfares. Apple faced more than a 2% decline as the U.S. Supreme Court rejected its appeal, upholding a lower court's decision mandating changes to App Store policies that could impact revenue. Energy stocks recorded significant declines amid fluctuating oil prices influenced by Middle East tensions and a stronger dollar following Waller's rate cut comments. EQT Corporation, Marathon Oil, and ConocoPhillips were among the notable losers in the sector. The day's market movements reflected a mix of earnings outcomes, central bank signals, and geopolitical factors influencing investor sentiment. All right, so kind of a mixed day. It's, not terrible. It's not, certainly, we're not dropping huge percentage points at this point. And, as far as the rate or the Fed cutting rates, what I think, this would be, again, total conjecture here, but I imagine they're waiting for some bad news to happen in the market so that they have a reason to lower rates. Because just lowering rates to lower rates, things aren't terrible right now. So they need a reason to do that so that they can be the hero and say, hey, see what we did. We lowered interest rates. We printed a bunch of money and see, you feel better already. But we know what happens. 3 years ago, well, it's going on 3.5 years ago, almost 4 years ago now, that we saw the consequences of money printing. It's not a good thing. All right, next up comes from Zero Hedge, why the market is gunning for an early Fed rate cut. And this was from Simon White, a Bloomberg macro strategist. The high probability assigned by the markets to an early rate cut by the Federal Reserve suggests growing financial instability risks, with investors anticipating a reduction in rates to prevent liquidity and funding issues. But again, they never do it when, the Fed's never proactive. They always wait till there's some sort of catastrophe before they step in and actually help. But usually that helps. The help usually winds up being more of a hindrance. While various theories attempt to explain the market's expectation of a March rate cut, the focus on reserves and financial stability provides a clearer picture. The separation principle, which distinguishes monetary policy from financial stability, is questioned as factors like funding costs, leverage incentives, and risk-taking are influenced by the size and composition of the Fed's balance sheet. With a large fiscal deficit, interest payments are poised to strain reserves and reserve velocity, intensifying risks from ongoing quantitative tightening program. The decline in reserves towards their lowest comfortable levels raises concerns about potential funding problems, as indicated by the recent rise in SOFR, which is the, where was that? What was that acronym for? Never mind. Banks are adjusting their expectations for the Fed tapering and ending quantitative tightening, with some forecasting an early start in April. The incentive to increase reserves buffers in anticipation of rising risks could lead to a rapid shift from superabundant to scarce reserves, impacting financial conditions. The potential end of quantitative tightening may happen swiftly at turning points, emphasizing the nonlinear relationship between reserves and financial conditions. Ultimately, an early rate cut is viewed as a means to relieve pressure on reserves from government interest payments and bolster banks' balance sheets, mitigating risks of funding market disruptions. Yeah, and that's another thing is that, each time the debt rolls over, they're having to, reissue that debt at current rates. So, before rates were basically at zero. So the Fed was just rolling, or the federal government was just rolling over those bonds at basically no interest. And now they're having to do it at, 4 or 5%. And, that's going to, cost us, the taxpayer, a lot of money. But, that's the big reason why they want to, at least those in government want to lower interest rates. All right. Last up comes from our friends over at First Trust, Mr. Brian Westbury. His article today, Budgets and Governing. Let's see what he had to talk about. All right. The leaders of the House and Senate have proposed a new budget deal, sparking discontent among many. The deal must be passed by January 19th to avert a potential government shutdown, because that would be terrible. Let's see here. The ongoing struggle over government spending has persisted for years, driven in part by significant increases in non-defense spending by the federal government, including entitlements like Social Security, which it'll be gone in a few years. Over the years, non-defense spending has surged as a percentage of GDP. It was 10% in the 60s, 14.8% in 2001, 15.2% in 2007, and 17.8% in 2019, projected to reach 22% of GDP over the next 5 years. This represents more than twice the GDP share compared to 60 years ago, with a 45% increase since just before the Great Recession and a 24% increase from the year before the COVID-19 pandemic. Despite being triggered by one-off events like the Great Recession and COVID-19, government spending has not returned to pre-crisis levels, contributing to rising deficits. Why aren't we? I mean, there's no reason not to go back. I mean, yeah, you hired a bunch of federal employees, but fire them. It's not that hard. The budget battles have become increasingly contentious, marked by threats to not raise the debt ceiling or government shutdowns due to disagreements over budget agreements. The lack of electoral consequences for unconstrained spending has provided little incentive for politicians to alter course. I think some gallows might fix that. If you started hanging people for bankrupting the country, that might fix things. But what do I know? I'm just one guy out here in the middle of nowhere. The surge in total debt coincided with the Federal Reserve's artificially keeping interest rates low to combat inflation, caused poor policies, resulting in significant increase in net interest expenses. In the past 12 months, net interest expenses reached $730.4 billion, with expectations of exceeding $1 trillion per year after 2028. Like the federal government's going to last that long. While some advocate raising tax rates, history suggests that eliminating deficits through tax increases is challenging. The last balanced budget period occurred between 1998 and 2001, when government spending fell as a share of GDP. The current trajectory of rising government spending and deficits poses challenges to economic growth, and a return to fiscal responsibility is urged to address these concerns. I agree, Brian. You say these sort of things every week, and no one listens. But they'll be listening when they're eating dog food or having to eat squirrels or whatever because they're so broke and whatever. So anyways, all right. Well, that's everything I had for today. Sorry, I hope I didn't depress you too much with all the negative news, but that's just kind of the state of things right now. So if you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening. Hope it warms up wherever you're at, and I shall talk to you next time. Adios.